Welcome to video 9 of part 2 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here, back with you to discuss Specialized Topics 2 of 2. This is the final video in part 2 of the course, and we will discuss retirement plans as well as trusts and estates. Our free resources from irs.gov, the top 3 here have to do with retirement plans. It's publication 560, along with Form 5500 and 5500 EZ, along with their instructions. For estates and trusts, we've got Form 1041 and its instructions, along with publication 559. Let's start by talking about retirement plans. First, if you have not watched video 6 in part 1 of this course covering retirement plans, or if it's been a while since you watched it, I encourage you to watch that before watching this video. We will repeat some of the concepts here, but not in as much detail, and others I will assume you already know. So refamiliarizing yourself with that video will definitely help you, not only with this video, but with part 2 of the exam itself. In this video in particular, we will cover plans for the self-employed, qualified plans, reporting requirements for retirement plans, prohibited transactions, and then non-qualified plans. For the self-employed, we've got 3 types of plans primarily we're looking at. An individual retirement arrangement, or IRA, that is what video 6 in part 1 went into in detail, was IRAs. And those are much more likely to be tested on part 1 of the exam. However, many of the same concepts will apply here in part 2. Next are 2 different types of IRAs meant specifically for small businesses: a simplified employee pension, or SEP, and a simple IRA. So we'll look at each of these in a little bit more detail. So an regular IRA is available to self-employed people as well as it is available to anyone else. They can also allow their employees to contribute to an IRA via payroll deduction. However, if the employer wants to contribute to those employees' IRAs, they can do it, but it will not be tax-free. Any amounts that they put in to their employees' IRA accounts will be taxable income to the employee. So this is not usually what most small business owners will do, but it is an option that is available. But most of the time, they will go with one of the other 2 types of IRA plans, or they'll go with a different type of qualified plan. So the first of the IRA plans is the SEP, the Simplified Employee Pension. So this allows the employer to make tax-free contributions to their own account as well as to their employees' accounts. The employer contributions are tax deductible by the business. The employees do not pay any tax on the contributions, and the amount is not included in their wages. And these accounts are very easy to set up, and they are subject to certain rules. So eligible employees for a SEP must be at least 21 years of age. They must have been employed with the employer for at least 3 of the last 5 years, and they received at least $750 of compensation in the current year. The employer can actually have less restrictive guidelines than those, but not more restrictive. So if the employer wants to allow other people who don't technically meet these requirements in, they can. So if they want to let 18-year-olds into the plan, they can, for example. Or if they want to let anybody who received wages in the current year participate, they can do that. They just cannot have more restrictive eligibility requirements than those that are listed here. And then starting in 2023, a SEP can be set up for a domestic employee, such as a nanny. So you might look for a question on the 2024 exam about that, since it is a new rule for 2023. For a SEP, the employer can decide how much to contribute each year, and they don't have to contribute anything. So there's no required contribution, But if they're going to make contributions, they must be a uniform percentage of pay for each employee. They cannot discriminate in favor of highly compensated employees. So in other words, they can't say, so I, as the owner, will get a higher percentage than the rest of my employees. You can't do that. They can't discriminate. Employer contributions to any one employee cannot exceed 25% of compensation, and the maximum employer contribution is $66,000. That is a number you will want to know for the exam. And then also, importantly for a SEP, employees cannot make contributions to their own plan. So remember that with this simplified employee pension, the employee cannot make contributions to the plan. Only the employer can make those contributions. A simple IRA, a savings incentive match plan for employees. So this allows employee contributions and requires employer contributions. So remember, with the SEP, did not allow employee contributions, and employer contributions are optional. They are not required. So for a simple plan, eligible employers must have 100 or fewer employees who received $5,000 or more in compensation in the preceding year, and the employer cannot maintain any other type of qualified retirement plan. Now, if the employer goes over 100 employees, they have a 2-year grace period to end that simple IRA, and they can start a different qualified plan if they choose to do that. Employees who received $5,000 or more in wages in any of the preceding 2 years, and those reasonably expected to receive $5,000 or more this year, are eligible to participate. Again, the employer can be less restrictive than that, but they cannot be more restrictive than that. The employer has 2 options for how they make their contributions. They can either match employee elective contributions, or the employer can make non-elective contributions. So if they're going to match employee contributions, they must match those contributions dollar for dollar up to 3% of the employee's pay. And the maximum employee contribution is $15,500 per year, unless the employee is age 50 or older, in which they can make catch-up contributions of $3,500. So if you're 50 or older, you can contribute up to $19,000 for the year. The employer contribution, remember, they're supposed to match employee contributions dollar for dollar up to 3%. But they will allow you to go as low as 1%, but not in more than 2 years of the last 5, and they have to give notice to the employees. So what they're allowing for here is that there might be some years that are better than others. So they're going to allow you to stray from that 3% once in a while. So no more than 2 of the last 5 years, that 3% number can go down to as low as 1% for the employer matching contributions. If the employer elects to go with the non-elective contributions, that means the employee doesn't have to contribute anything. The employer then will still make a contribution to the plan, or even if the employee does elect to make contributions, the employer is still going to make the same amount of contributions. So in that case, the employer will contribute 2% of the pay to each employee who has at least $5,000 of compensation. And again, the employee does not have to make any contributions to receive their 2%. And the limit per employee is $6,660. It's 2% of a maximum salary of $330,000. That's the maximum contribution into the simple IRA when the employer goes with these non-elective contribution of 2% of pay. For both SEPs and simple IRAs, there are certain employees who may be excluded from either type of plan. And in other words, the employer does not have to include these employees. First of all, any union employees who have retirement benefits with their union, you do not have to include them in the plan. And any non-resident alien employees who have received no US-based income from the employer. So maybe they are an employee, but they work in another country, and so they haven't received any US-based income, then they do not have to be included in the plan either. Starting in 2023, so again, a new rule in 2023, Roth IRAs are allowed for a SEP and simple. And of course, you'll remember what a Roth IRA is from the video in part 1. And we will talk a little bit more about other type of Roth plans here coming up. All the normal rules for IRAs apply, such as the 10% penalty for early withdrawal and the rollover rules, etc. So again, another reason you will want to be familiar with the video in part 1. And the business may be eligible for a tax credit for setting up a retirement plan if they use a SEP or simple, just as they would for the other types of retirement plans we'll be talking about coming up. In order to get that credit, they use this Form 8881. So now let's talk about other types of qualified plans. So qualified plans allow employees and employers to contribute on a tax-advantaged basis. We'll talk a little bit later about non-qualified plans. So the big distinction between qualified and non-qualified plans is the tax advantages, meaning the employer gets a deduction for making the contribution to the plan, and the employee does not have to include the contributions in their wages. These other types of plans are more flexible than the SEP and simple IRAs that we talked about, and they often have higher annual contribution limits, but they're also more complex. They're more expensive to maintain, and there are reporting requirements that are required with these other types of plans. There are two basic types of qualified plans: defined contribution plan, such as a 401k or a 403b, and a defined benefit plan, which is your typical type of pension. And there can also be combination types of plans. Qualified plans are subject to ERISA, which is the Employee Retirement Income Security Act. ERISA is designed to protect employees by making sure that plans are fair to all the employees, so there's not discrimination for the owners or the more highly compensated people in the company. It also makes sure that they are adequately funded and that the funds are protected from diversion or misuse. So there are lots of rules around these retirement plans in order to protect the plans from being raided or from the company stealing the money for other uses. So they are very highly regulated plans. And then ERISA also sets forth all the various requirements for who's eligible for what's called vesting, reporting, etc. Qualified plans have the following characteristics there that are listed on the slide. The plans must not be diverted for other uses, so the company can't take the money and use it to cover operating costs or anything like that. There are minimum coverage requirements that must be met. In other words, who in the company is covered by the plan and is allowed to participate. There are minimum requirements for that. Contributions or benefits cannot discriminate in favor of highly compensated employees. Contributions and benefits cannot be more than certain limits. There are minimum vesting standards that must be met. So vesting is when the employee becomes entitled to the employer contributions. So if the employee were to quit and leave the company or leave the company for any reason, when are they entitled to take with them the employer contributions? They're always entitled to take their own contributions, but vesting has to do with when they are entitled to take the employer contributions and any earnings that were earned on the employer contributions. There are minimum participation standards that must be met. So a certain percentage of the employees must actually participate in the plan. Not just that they're allowed to participate, but they actually do participate. Employer contributions, as we said, are deductible within the limits, and the accounts grow tax-free or tax-deferred. And employee contributions are deducted from taxable wages, except for Roth type of plans. So we're going to talk about the different types of plans, and so you'll see some of these same ideas come up again. We'll get more specific. So let's first talk about defined benefit plans. So these are your traditional type of pension plans. So the employee becomes entitled to a monthly payment for life upon retirement, and the amount of the payment is based on the number of years of service with the company and the amount of annual salary, and there can be other factors in there. Employer contributions are mandatory, and the accounts must be funded to certain actuarial standards. These plans are very expensive to maintain, and they're becoming less popular in the business world. They're now mostly found with governmental types of employers. So this is that typical, you work for the company for 30, 40 years. The amount of your pension is going to be calculated based on some formula. Like it'll look at maybe your last 3 years of pay. It'll say what's your average pay for the last 3 years. And then based on how many years you've worked there, you'll get some percentage of that average pay for the last, in our example, 3 years. And then you will then get a monthly payment for the rest of your life. No matter how long you live, you will get a monthly payment, and that is your pension. So that is a defined benefit plan. So the benefit, that monthly amount that you get, is defined by the plan based on those various factors. Next is a defined contribution plan. So this provides individual accounts for each participant in the plan. It provides benefits largely based on the amount contributed. So there's no guaranteed monthly amount that you're going to get for the rest of your life. Instead, the benefits are going to depend on how much is in your account when you retire, which is going to depend on how much has been contributed. It's also going to be affected by how much has been earned. So by any income in the account, by any expenses of the account, by any gains or losses in the account, and by any forfeitures of other accounts that may be allocated to a particular account. So in these types of plans, if you have employees that start with the company, they're participating in the plan, they're getting their own contributions, they're getting some employer contributions. But if they leave within a short period of time before they are vested in their employer contributions, then generally what happens, any amounts in their account that are from employer contributions will get reallocated out to everybody else who's participating in the plan. Of course, if that employee leaves, again, they get their own contributions back, so that will go with them. But if they have not vested yet, or if they have not fully vested, then the employer contributions will generally be distributed out to the other participants in that plan. So that can also grow the plans of those other participants. These are the various types of defined contribution plans. We've already talked about the SEP and the simple. So for the rest of this time, we're going to talk about these other types of plans. So this would be your typical 401k plan if you're working for a for-profit business, or a 403b plan if you're working for a not-for-profit or governmental type of employer, or a thrift savings plan if you're working for the federal government. So these plans, the 401k, the 403b, and the thrift savings plan, are all very similar. It's just what type of organization that you are working for. Then there's also an employee stock ownership plan, an ESOP, that is a type of defined contribution plan, stock bonus plan, and then you can have a profit sharing plan or a money purchase plan, which is kind of layered on top of these other plans. So we will talk about those as well. For these 401k, 403b, and the TSP plans, the employee can make what are called elective deferrals, meaning part of their pay is put into the plan on a pre-tax basis. It's called elective because the employee can choose whether or not to make the contributions to the plan. If they do choose to do so, then that pay goes into the plan on a pre-tax basis. Generally, for this is for what we would call a regular type of plan. We'll talk about Roth plans here next. But for a regular 401k, 403b, TSP plan, those contributions go in pre-tax. So it's not included in their W-2 wages. Then the employer may or may not also make contributions to the plan. The funds that are in the plan are invested and they grow tax-free. And then when the employee retires, they can withdraw the funds and they owe tax as those funds are distributed. So with a traditional or regular type of plan, they put the money in, it's tax-free. The money grows tax-free or tax deferred. But when they retire and take the money out, then they are going to owe tax as those funds are distributed. Next is the Roth type of plans. So here the employee can still make their elective deferrals, but the funds do not come out of their paycheck tax-free. So they will still pay tax on that money. And then when they put the money into the Roth, it comes out on an after-tax basis. And the employer can still make contributions to that plan. The funds are invested and they grow tax-free. But the difference here is with a Roth, since it came out on an after-tax basis, when the money comes out, it comes out tax-free. So when they retire, take the money out, it is all tax-free, both their contributions, the employer contributions, and the earnings, how much ever it is earned over the years, it all comes out tax-free. So with a traditional plan, you get the tax benefit now because you get the deduction now, but then you're going to pay income tax later when the money comes out. With a Roth plan, you don't get the tax benefit now because the contributions come out on a post-tax basis, but then you don't have to pay tax later. You get the benefit later when you take the money out. You don't pay taxes on it. The employee contributions to any of these type of plans, whether it's a 401k, 403b, or a TSP plan, and whether it is a traditional or a Roth plan, the employee can contribute up to $22,500 per year. That is the number for 2023. So that's the number you want to know for the 2024 exam. You will want to know this number, $22,500 per year. If the employee is age 50 or older, then he or she can contribute an additional $7,500 per year, so a total of $30,000. So you will want to know those numbers, $22,500 and $7,500 extra if they are age 50 or older. For the employer contributions, the amount is limited to 25% of the combined compensation of all employees. For any one employee, the combined employee and employer contribution cannot exceed the lesser of the employee's compensation or $66,000. So the employee can actually put in the total amount of their paycheck, or they can have the combined amount of their contribution and the employer contribution can be up to their entire wage, or a maximum of $66,000 for the year. Again, that's another number you will want to know. And that does go up to, again, they get another $7,500 if they are age 50 or older. So it can be up to $73,500 if they are age 50 or older. Vesting. So while the employee always has the right to the amounts that they've contributed, They do not vest in the employer contributions until they have worked for that employer for some period of time. So there can be a couple of different ways that they can have vesting. The first is 100% vested after 3 years of service. So this is sometimes called cliff vesting, because for 3 years, if you think about an employee, like if they're walking along, for 3 years, they're not entitled to anything. So they keep walking along. They keep working for the company. 1 year, 2 years, 2.5 years, 2 years, 11 months, 2 years, 11 months, and 29 days. They're not vested. If they leave, they do not get any of the employer contributions to their plan. But once they hit 3 years, it's like they fall off a cliff. Now, all of a sudden, they get 100%. So they get nothing, 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 nothing. If they leave for the first 3 years, once they hit 3 years, they're entitled to 100% of the employer contributions, along with all of the earnings on those contributions. The other type of vesting plan you can have is this one that's more gradual. So with this one, they get nothing for the first 2 years. Still applies that for the first 2 years, they don't get anything. But if they leave after 2 years, then they get 20% of the employer contributions and the earnings that went along with it. After 3 years, they get 40%. After 4 years, 60%. After 5 years, 80%. And then finally, after 6 years, they get 100%. So the employer, when they set up the plan, they can set up either of these. So it's not something the employee gets to choose. It is something that is built into the plan and the plan document in the way that it is written, one of these two types of vesting schedules. Distributions from qualified plans. Distributions from traditional plans are generally taxable, as we said. Distributions from Roth plans are generally not taxable. Distributions before age 59 and a half from either type of plan are subject to a 10% penalty in addition to any income tax due unless an exception is met. So this is similar to the IRA that we talked about in part 1. If you take distributions before age 59 and a half, again, that's an age you're going to want to remember for the exam, distributions before age 59 and a half, whether it's a Roth plan or a traditional plan, they are subject to a 10% penalty for early withdrawal unless one of the exceptions is met. These are going to be essentially the same exceptions we saw for the IRA in part 1. So I'm just going to go over them kind of quickly here and highlight a few of them. So you can take the money out without penalty if you're using it for unreimbursed medical expenses that are more than 7.5% of adjusted gross income. If you are totally or permanently disabled, if you are terminally ill, and very importantly, if you are receiving the distributions as part of an annuity. So if you want to retire before the age 59 and a half, what you can do is set up an annuity, meaning you'll get a certain amount per month, for example, for the rest of your life, or a certain amount of month for a certain number of years, for the next 20 years or the next 30 years, etc. So if you annuitize your account, then there's no penalty. So the amounts that you get before age 59 and a half will not be subject to this 10% penalty. Other exceptions, if you're using the money for qualified higher education expenses, up to $10,000 for a first-time home purchase, not in excess of $5,000 if you're using it for a qualified birth or adoption. And then there are, again, certain other exceptions that are listed here and that we went over in part 1. Rollovers, again, like IRAs that we talked about before, qualified plans can be rolled over tax-free to another qualified plan, for example, at a new employer, or into an IRA. And unless it is a trustee to trustee rollover, the distribution is subject to 20% federal income tax withholding. So this is one of those things when you are advising clients, you always want to advise them to do a trustee to trustee rollover. So what that means is if you are leaving your job, and let's say you've got money in a 401k plan, and now you're leaving and you want to roll that money over into an IRA, what you would want to do is request that your 401k plan just send the money directly to the bank or financial institution where you're setting up the IRA. You do not want them to send you a check for the amount that's in the 401k plan, and then you go deposit that check into the IRA. And the reason is because when the 401k plan issues that check, they are required to withhold 20% for federal income tax. But if you want that rollover to be done tax-free, you have to contribute 100% into that new IRA. But you're only getting a check for 80%. So that means you're going to have to come up out of pocket with the additional 20% if you don't want to pay any tax on it. So in order to avoid all that hassle, just do this trustee to trustee rollover. Required minimum distributions. Just like IRAs, qualified plan owners must take a minimum distribution every year once they reach age 73. And in 2023, this applies to both traditional and Roth type of plans. However, starting in 2024, it will not apply to Roth plans, which makes sense. It doesn't apply to Roth IRAs. It shouldn't apply to Roth 401k, 403b, etc. plans either. And so starting in 2024, it will not. The amount of the required minimum distribution is going to be based on the account balance and the age of the account owner. That is something that the trustee of the plan will figure out. You don't need to know that for the EA exam. Loans from these retirement plans. A loan from a qualified plan will be treated as a distribution and therefore subject to tax and maybe penalties unless the loan meets one of two exceptions. Either the proceeds are used to buy a main home or the loan is required to be repaid within 5 years. So the good news is you actually can take a loan from your 401k plan as long as you are doing it to buy a main home or it is required to be paid within 5 years. Remember, you cannot take a loan from an IRA, but from one of these other types of plans, you can take a loan. You just have to make sure that you meet these exceptions. Otherwise, that loan will be called a distribution and you'll be subject to tax on it. And if you're under age 59 and a half and you don't meet any of the exceptions, you'll also be subject to penalty. A simple 401k plan. So a simple 401k plan is kind of similar to the simple IRA. It doesn't have to pass any of the non-discrimination tests, which makes it easier and more cost-effective to maintain than a larger plan. Again, as with the simple IRA, eligible employers must have 100 or fewer employees who receive $5,000 or more in compensation in the preceding year, and the employer cannot maintain any other type of qualified plan. The employer must make contributions each year, and they are 100% vested immediately. And like the simple IRA, the employer can either match employee elective contributions or make non-elective contributions. And again, if they're going to match, then they have to match dollar for dollar up to 3% of the employee's pay. Now, the one thing that is different from the simple IRA is they cannot lower that to 1% for 2 out of the last 5 years, like they could with the simple IRA. If you got a simple 401k, and you're going to match elective contributions, then you must do the 3%. So dollar for dollar, up to 3% of the employee's pay. Again, the maximum employee contribution is $15,500 unless they're over age 50, in which case they get the additional $3,500. And then if the employer wants to make non-elective contributions, then it is 2% of the pay to each employee. The employee does not have to make contributions to receive the 2%, and the limit is still that $6,660 that we talked about before. Another type of 401k is the solo 401k plan. This can be set up by a sole proprietorship. Since there are no other employees, there's no non-discrimination rules to worry about. The employee can contribute the normal amounts equivalent to salary deferral, which is $22,500 per year if under age 50, or the larger amount if they're 50 or older. Plus, the employer can contribute an additional amount up to 20% of net profits. So, what it comes down to is the maximum contribution is $66,000 for the year. Again, that's a number we have seen before, and you will want to remember for the EA exam. A profit sharing plan. So, a profit sharing plan, it doesn't actually require that the business has a profit in order to fund the account. But what it does is it allows the employer to decide each year whether or not to make contributions. So it's discretionary whether or not the employer makes a contribution and how much they contribute. But the plan must provide a formula for allocating contribution among participants and for distributing accumulated funds when employees reach a certain age, number of years of service, or upon certain other occurrences. So, in other words, the employer doesn't have to make contributions, but if they're going to, they've got to have a written formula and plan for how these contributions get made and for all of the other things that affect the plan. So they can't just decide this employee gets this much this year and this other employee gets this much. It has to be based on a formula. And of course, it cannot discriminate. So, what employers will often do is layer this type of plan on top of like a 401k plan. So they have a 401k plan where the employee can make elective contributions. And then instead of making regular 401k employer contributions, they'll have a profit sharing plan instead. So they'll say each year, they'll determine that either, yes, we'll make contributions to the plan this year, or no, we won't. And if they do make contributions, then those amounts will go into those employees' 401k plans based on the formula. Similarly, is a money purchase pension plan, but the difference here is that the amount or the percentage that they're going to put in is fixed, and it isn't based in any way on business profits. And then the employer has to put the money in every year. So, for example, the plan might say that the contribution is 10% of the participant's compensation without regard to whether or not there's a profit. And so then the employer is required to make these contributions each year in the percentage that is laid out in the plan. Prohibited transactions. So you'll remember with IRAs, there are prohibited transactions. So we have the same thing with qualified plans. So what a prohibited transaction means is that a disqualified person is prohibited from entering into certain types of transactions with the plan itself. And the penalty is that a tax must be paid. And a disqualified person includes plan fiduciaries, people providing services to the plan, company owners, officers, highly compensated employees, and their family members, and similarly situated individuals. So this is kind of like the related party rules. Anybody who is closely associated with the plan itself, including the employer that sets up the plan and the people that run the plan, the fiduciary of the plan, any of those type of people are going to be prohibited from entering into certain types of transactions. Those are prohibited transactions. So, for example, prohibited transactions include a transfer of plan assets or income to the disqualified person. So, the fiduciary can't take the money for themselves, or the employer, the owner of the company that set up the plan, can't take the money for themselves, obviously. An act of a fiduciary by which they deal with plan income or assets in their own interest, not allowed. The receipt of consideration by a fiduciary for their own account from any party dealing with the plan in a transaction that involves plan income or assets. So they can't get any type of bribe or kickback or anything like that for people who are dealing with the plan. Any of the following acts between the plan and a disqualified person: selling, exchanging, or leasing property, lending money or extending credit, furnishing goods, services, or facilities. There are certain transactions that are exempt from being considered prohibited. So, for example, if the disqualified person receives a benefit to which they are entitled because they are a plan participant or a beneficiary, then that will not be considered a prohibited transaction. So, for example, if the owner of the company is an employee of the company and they are getting a benefit from the plan just like all the other employees are getting, then that is not a prohibited transaction, as long as the benefit is computed and paid under the same terms as it is for all other participants or beneficiaries. So these disqualified persons, if they're eligible to participate in the plan as an employee, then they are entitled to all the same benefits as the other employees. They just can't get extra benefits on top of that. There are other exempt transactions that are found in Section 4975 and the regulations if you're interested, but the ones we've listed here are what are important for the EA exam. If you have a prohibited transaction, remember the penalty for that is a tax. So the initial tax is 15% of the amount involved for each year or a part of the year in the tax period. If the transaction is not corrected within the tax period, an additional tax of 100% of the amount involved is imposed. So sometimes somebody will enter into one of these prohibited transactions accidentally. They don't mean to do it, or they weren't thinking, and something happens and they do a prohibited transaction. Well, if they do that, they are going to have to pay this 15% tax regardless. But if they don't correct the mistake within the tax year, they're going to pay 100%. So they want to make sure that if these things happen, that they are corrected, or that the person who is violating this really has to pay a stiff penalty. Because again, this is people's retirement money you're dealing with. You've got ERISA that has these rules, and their job really is to protect these retirement assets for the employees and the beneficiaries. So they're going to put in very strict requirements and very strict penalties for not protecting those plan assets. So that's why you have these very high taxes for violating these rules. These taxes are payable by any disqualified person who participated in the transaction, other than a fiduciary acting only as a fiduciary. If more than one person takes part in the transaction, each person can be jointly and severally liable for the entire tax. So if two people participate in it, one person doesn't have any money, they can't pay it. The other person can be liable for the entire amount of the tax. Moving on to reporting requirements for qualified plans. You have to file an annual return on the Form 5500 or one of the 5500 series by the last day of the seventh month after the plan year. So that's July 31st for calendar year plans. So you will want to remember that last day of the seventh month is when the Form 5500 is due. However, these 5500s do not have to be filed for the SEP IRA and the simple IRA. The simple 401k, yes. The simple IRA, no. And these 5500 forms are available to the public, so they are open to public inspection. Again, ERISA is wanting to protect the money for the beneficiaries of the plan. So they want transparency. So that's why these 5500s are available to the public. The 5500 SF. So smaller plans do not have to necessarily fill out the big Form 5500, which is much more detailed. Smaller plans can fill out one of these other types of forms. So the first one that they may be able to fill out is the 5500 SF, or simplified form. So they can fill this out if they meet all of the following criteria. The plan is small, which means fewer than 100 participants at the beginning of the plan year. The plan is not required to be audited by a CPA. The plan has 100% of its assets invested in certain secure type of investments that have a readily determinable fair value. So this would be your typical mutual fund type of plans that you see in retirement plans. The plan holds no employer securities. So there's no stock in the employer company itself in these plans. And the plan is not a multi-employer plan. So if you meet all those criteria, you can fill out this simplified form. Then there is the Form 5500 EZ. This is for one participant plans, which means either the plan covers only the owner and their spouse, or it covers only one or more partners and their spouses in a partnership. A one participant plan must file either a 5500 SF or a 5500 EZ. They cannot file a 5500. And a one participant plan does not have to file at all if it has assets of $250,000 or less at the end of the plan year. However, they should file in the final plan year to show that all plan assets have been distributed. So if you're a one participant plan and you've got less than $250,000 of assets and it's not your final plan year, then you do not have to file any type of 5500. If you don't meet the requirements for a 5500 SF or 5500 EZ, then you file the Form 5500. All of the 5500s and 5500 SFs must be filed electronically with the Department of Labor. So it doesn't go to the IRS, it goes to the Department of Labor, and they have this system called the eFast2 system. That is how you electronically file it. One participant plans can either file the 5500 SF electronically, or if they're filing the 5500 EZ, they file that on paper with the IRS. So it's different if you got a one participant plan and you are filing the 5500 EZ. You'll want to remember that difference. Now let's talk about non-qualified plans here for a minute. Non-qualified plans are not subject to ERISA, so this allows them to discriminate in favor of highly compensated employees. So you can have a plan where the owner or other highly compensated employees get a disproportionate benefit than other employees. But as a result of this, they don't get the tax benefits. So the amounts received by the employee will be taxable for these type of plans. The employer does still get a deduction, but the employee has to pay tax on the amount that they receive. What a non-qualified deferred compensation plan does is it allows a benefit to accrue now and be paid later. So they can say to the employee, all right, you earned this much, but we're not going to pay it to you now. We will pay it to you later. No deduction is allowed nor tax imposed until the amounts are actually paid. So even if you have an accrual basis employer, the business is on the accrual basis, they cannot take a deduction for these amounts until the amount is actually paid. And the employee does not have to pay tax on it until it is actually received. So examples of non-qualified plans, some of the names that you will hear are a phantom stock plan, a rabbi trust, or a taxable trust. Those are examples of non-qualified plans. There is one type of non-qualified plan that actually mimics a qualified plan. These are called Section 457 plans. They're offered mostly by state and local governments. They're not subject to ERISA, but they work much like a 401k or a 403b plan, including allowing pre-tax contributions and tax-deferred growth. They can also allow for Roth contributions, and they can be offered in addition to a 403b plan, and they have separate annual contribution limits. So this governmental employer can actually set up both a 403b plan and a 457 plan, and they have separate contribution limits. So it allows those employees overall to contribute more than if they just had one of the plans. So now let's move on and talk about trusts and estates. Here's what we will talk about. First, we'll talk about trusts, then estates, then the filing requirements, the tax years, and the penalties involved, income in a trust or estate, specifically accounting income and distributable net income, then exclusions, exemptions, and deductions, and finally, separately stated items. First, a trust. A trust is an entity formed under state law to hold assets for the benefit of a beneficiary. They are often used in estate, family, and business succession planning. So there are attorneys who specialize in estate planning, so they will be very familiar with these trusts, and that's often what they are used for, is to avoid probate and to lower estate taxes. They are also used to provide for the welfare of a person who cannot care for themselves or to provide money to a charity. So there's various types of trusts. There are three parties to a trust. The grantor, they are the one who are actually contributing money or property to the trust. The trustee, or sometimes called the fiduciary, is the person or entity responsible for carrying out the terms of the trust. So sometimes this will be not an individual, but for instance, a financial institution. So a lot of banks and other financial institutions will have a trust department. And so people will use that bank as their fiduciary for administering the trust. And then there's also a beneficiary, one or more beneficiary of the trust, and that is the person who receives the income and or the assets from the trust. This can be the same person as the grantor in some cases. So they can be the one who put in the money for the trust, and they can also be the beneficiary of the trust in some cases. A trust is a separate legal entity, therefore, it may be required to file an income tax return depending on the type of trust and the amount of income in the trust. A trust that files a return is also a pass-through entity and issues a Schedule K-1, similar to how a partnership or an S-corp does. There are different ways to distinguish types of trusts. One of those ways is as either simple or complex. So a simple trust is one that must distribute all of its income every year. It cannot accumulate any income from year to year. It does not distribute its principal, and it makes no distributions to charity. So that is a simple trust. A complex trust is any trust that is not a simple trust. Therefore, a complex trust can accumulate income from year to year. It can either distribute the income or not distribute it. It can distribute the principal of the trust, and it can make distributions to charity. Grantor trusts. A grantor trust is one where the grantor, remember they're the ones who contribute the property to the trust, where the grantor retains control over the assets and can revoke the trust and make any changes to it at any time. So this is your typical living trust. If you've heard of a living trust, where while you're alive, you put your assets or many of your assets into the name of the trust. So the assets are titled in the name of the trust, and upon death, they are distributed according to the terms of the trust. So what this does is it avoids probate, but it has no effect on income or estate taxes. So people will use this in addition to a will. So if you have a will and you leave things to your beneficiaries, then you have to go through this probate process with the courts in the county where you live. That can be a very prolonged process, and it can be a real hassle. And it's open to public display. Anything that happens in the courts is open to the public. So people will set up a living trust to avoid all of that. So they will put their house and their cars and their bank accounts and other significant assets in the name of the trust. And that has absolutely no effect on a day-to-day basis. While they're alive, everything is normal. They're still living in their house, they're still driving their cars, they're still using their bank accounts. It's just that if you look on the title or on the statement, you'll see the name of their trust instead of their individual name, but it doesn't actually affect anything. But once they die, now those assets, since they're in the name of the trust, those assets will be distributed according to the terms of the trust, and it will avoid having to go through that whole probate process. So even though it is a separate legal entity, it is not going to be recognized as a separate taxable entity. The IRS considers the assets and income to belong to the grantor. So it is a real thing. It's legitimate. It is a separate legal entity. The IRS just doesn't recognize it, and instead they're going to look to the grantor for any taxes. A non-grantor trust. This is any trust that is not a grantor trust. The non-grantor trust is recognized as a separate legal and taxable entity, and it reports its income and expenses on Form 1041. Some examples of a non-grantor trust are an irrevocable trust. So once the assets are put in the trust, it cannot be revoked. A disability trust, which is for the benefit of a disabled person under age 65. And a charitable trust, which is an irrevocable trust in order to make charitable contributions. There's a special type of trust you should know about for the EA exam. It is called a Credit Shelter Trust, or CST. This is primarily for married couples whose estate exceeds that maximum $12,920,000 estate exemption that we talked about in part 1. With a CST, when the first spouse dies, the assets go into the trust and no estate tax is due. The surviving spouse has limited access to the trust's assets and income during their lifetime, and then when they die, the assets pass to the beneficiaries, such as the children or grandchildren, and they do so without estate tax. The CST itself is subject to income tax on its earnings, just as the surviving spouse would be if they held the assets. Fraudulent trusts. We talked a little bit about this when we were talking about business expenses. So sometimes trusts will be promoted as a legal way to avoid income taxes or to deduct personal living or educational expenses that would not otherwise be deductible. But as we talked about before, there is no trust or series of trusts that can do this. And it doesn't matter if you've got trusts combined with LLCs, combined with corporations, et cetera, and so forth. You cannot turn personal living expenses into business expenses, and you cannot escape income tax by putting amounts into a trust. The income in the trust is going to be subject to tax by someone. Either the trust itself is going to pay taxes, or the grantor or the beneficiaries are going to pay taxes. But you can be assured someone is going to be liable for taxes on that income. So these trusts that these promoters are promoting are not legal, and the users and promoters of those trusts can and do face criminal charges. When legitimate trusts are used for estate, family, or business planning, those trusts must pay tax on any income that they generate. So just remember that. Don't fall for it. And just know that anyone who tells you that you can avoid income taxes or deduct otherwise non-deductible expenses by setting up a trust or a series of trusts is lying to you. and they are committing fraud. Foreign trusts. The IRS is very suspicious of foreign trusts and that they are being used to evade income tax. So it's not true that every foreign trust is set up in order to evade tax, but many of them are. So the IRS is going to scrutinize them very closely. So, what is a foreign trust? So, it's any trust that has a non US fiduciary or one that is not subject to a U.S. court. That is the definition of a foreign trust. When a U.S. person forms, contributes assets to, receives distributions from, or becomes the owner of a foreign trust, then they have to file this form, the Form 3520 or the 3520A, in order to notify the IRS. And foreign trusts are also subject to all the same FBAR and foreign account reporting requirements as individuals and other entities, as we have covered in other videos. So now let's talk about estates. An estate is similar to a trust, except it is automatically created by a one-time transfer of assets upon death. So when someone dies, there is automatically created an estate. The estate is temporary and will cease to exist once all of the assets have been distributed. Like a trust, an estate has a fiduciary, so they are often called a personal representative or an executor. Depends on state law. Each state has a different name for it. And that person is charged with distributing the assets according to the wishes of the decedent and the law. The estate also has beneficiaries, just like a trust does, and those beneficiaries will receive the property from the estate. So, filing requirements for trusts and estates. Trusts and estates report their income and expenses on Form 1041. The personal representative must file a return for an estate if it had gross income of $600 or more, or a non-resident alien as a beneficiary, or a qualified investment in a qualified opportunity fund. Don't worry about what a QOF is. Just know that if there has an investment in one, then there must be a 1041 filed for that estate. For a trust, the fiduciary must file a return if it had any amount of taxable income, gross income of $600 or more, there's that number again you'll want to remember, or a non-resident alien as a beneficiary, or a qualified investment in a qualified opportunity fund. So any of those things, a trust must file a 1041. A grantor trust, remember that's like the living trust, does not need to file a return as long as the grantor reports all of their income and expenses on their Form 1040. However, a grantor trust is allowed to file a Form 1041 if they want to, but they do not report any income or expenses or issue a Form K1. Tax year. For an estate, the first tax year begins the day after the date of death. That first tax year can end on the last day of any month. However, it cannot be longer than 1 year. Most estates just choose 12/31 of the year of death, but it is sometimes beneficial to choose a different month. So most of the time, you will see an estate has a calendar year end. A trust must generally use a calendar year unless something called a Section 645 election is made. And a 645 election allows a qualified revocable trust, for example, a living trust after the death of the grantor, and a state to file a combined tax return. The trust would then have the same year end as the estate, which can be different from a calendar year. So if someone dies and they have one of these living trusts, and the fiduciary wants to choose a different year end than the calendar year end, then they can do so. And then in that case, the trust and the estate will file together and they'll use the year end of the estate. That's what the Section 645 election allows. Filing deadlines. The Form 1041 must be filed by the 15th day of the fourth month following the end of the tax year. So that is April 15th for a calendar year. So it's the same as for a 1040, as long as it is, in fact, a calendar year, but is the 15th day of the fourth month. They can get an automatic 5.5-month extension using Form 7004. So it is not the normal 6-month extension that we see with the business type of entities. It is only 5.5 months. You will want to remember that. The filing extension does not extend the time to pay. That's the same as with other taxpayers. Late filing and late payment penalties apply, same as with the Form 1040. And the late filing penalty may be excused if there is reasonable cause that is shown. The failure to provide Schedules K1 by the due date can result in a penalty per K1 of the greater of $310 or 10% of the items required to be reported on the K1. So this can get very expensive. So the fiduciary wants to make sure that they do file the return and get those K1s out on time. Income in an estate and trust. Estates and trusts compute gross income the same way an individual does, and they have many of the same types of income, such as investment income, capital gains, rents, business or farm income, and income from K1s. So an estate or trust can own a business. They can own rental property. They can own a farm. They can own investments. And so they can have income from all of those things. And they can actually have to file a Schedule C for a small business or a Schedule E for rental properties, etc. States and trusts get a deduction for any income and other amounts that are properly distributed to the beneficiaries. So if the estate or trust distributes out income to the beneficiaries, then the beneficiaries will pay tax on that amount. So the estate or trust gets a deduction for it. So it's not going to be taxed both at the estate or trust level and at the beneficiary level. It's going to be one or the other. The estate or trust can also deduct other expenses such as interest, professional fees, administrative fees, as well as the amounts that are flowing out through the K1s. However, an estate or trust cannot take a Section 179 deduction. Exemptions. Estates and trusts get an exemption, which is designed to keep very small entities from needing to pay tax. So the exemption amount is going to depend on the type of entity. For an estate, it is $600. So if they've got less than $600 of taxable income, then they're not going to have to pay any tax. For a trust that is required to distribute all income currently, that amount is $300. For a qualified disability trust, it is $4,700. And for all other trusts, it will be $100. So the main thing, the $600 for an estate, $100 for most trusts. But then if you got these special trusts, then you've got the $300 or the $4,700. So you should remember those amounts. Accounting income. So we're going to talk about a couple of different concepts that apply to trusts. First is accounting income. So trusts can have two types of beneficiaries, an income beneficiary and a remainder beneficiary. Income beneficiaries receive income earned on trust assets. Remainder beneficiaries receive the assets when the trust ends. Accounting income is the net income available to income beneficiaries. So you can have a trust that is set up so that while a particular person is alive, they get all of the income from the trust. So they are the income beneficiary. And then when that person dies, the remainder will go to someone else. So that is the remainder beneficiary. So we use this concept of accounting income to determine the amount that is available to be distributed to the income beneficiary. Income and expense items are attributed to either income or corpus. So corpus means body. So they are attributed either to income specifically or to the body or the assets of the trust. So, for example, Joe created a trust, and when he died, his son Christopher is entitled to all of its income for life. Interest, dividends, and rents are assigned to income, and capital gains and losses are assigned to corpus. The administrative and professional fees are paid equally from income and corpus. So all of these things are laid out in the trust document. He created this trust, and this is the terms that he set. So let's see how that would actually look. So these are the amounts here, the gross amounts column of income and expense that the trust had. So they had interest income of $2,000, dividends $4,000, rent of $22,000, capital gains of $16,000, paid administrative fees of $3,000, and professional fees of $2,000. So the net income that the trust had for the year was $39,000. So how much of that will be distributed to Christopher? How much is he entitled to? Well, he's going to get all of the interest, dividend, and rent income. He is not going to get any of the capital gains because that is assigned to corpus, not to income. And then remember, the administrative and professional fees are split 50-50 between income and corpus. So half of those fees are going to be deducted from Christopher's portion for accounting income. So that means his distribution will be $25,500. Next, let's talk about distributable net income. So taxable income in a trust or estate is taxable either to the trust or the estate or to the beneficiaries, but not to both, as we have said before. This is why the estate or trust gets a deduction for amounts properly distributed to the beneficiaries. The deduction to the trust or estate and the amount taxable to the beneficiaries is the smaller of the amount actually distributed or distributable net income. So, distributable net income acts as a cap or a maximum on the amount of taxable income to the beneficiaries. So, let's keep going with our example with Christopher to figure out what is the amount of distributable net income. So the gross amounts are the same as before, comes down to that net income of $39,000. And then the accounting income is the same that we came up with before. So we know that Christopher gets that $25,500. But how much of that is actually going to be taxable to Christopher? So that's what this distributable net income calculation will tell us. So all these amounts are the same. Interest, dividend, rent income doesn't get any of the capital gains. But then when we get to administrative and professional fees, when we are figuring out distributable net income, we're going to take in the entire amount of those fees, not just half of it. So to figure out DNI, we are going to deduct the full amount of those fees. And so that means the distributable net income is $23,000. So Christopher is only going to have taxable income from the trust of $23,000, even though he received a distribution of $25,500. Separately stated items. So, similar to a partnership or S Corp, certain items are separately stated to the beneficiary on a Form K-1. The main item that's on there are taxable distributions that are made to the beneficiary. Also, the beneficiary's portion of any tax-exempt income is going to be reported, and the beneficiary's portion of business income or loss is reported, along with items needed to compute the qualified business income deduction. Let's look at a Form 1041, and this actually has some sample data included in it. So at the top, we have all the normal information, plus you put in the type of trust it is and the other info. Then you're going to come down here and you're going to see the various types of income that the trust or estate can have. And then you're going to have various expenses and deductions that the trust or estate can have. And then you come down to the total tax and the amount due or the refund. Schedule A is going to be detail of any charitable deduction that is made. Schedule B is the detail of the income distribution deduction. So this is the amount that was distributed out. It's going to determine the amount of the deduction that is allowed. And then it is going to be the detailed tax computation along with the payments. Schedule G is going to detail the amount of the payments and where they came from. And then you're going to have this other information. So these are check boxes that lets the IRS know about various characteristics of the trust or the estate. And then this is a copy of the K1. What's very interesting on the Form 1041 is there is no Schedule K. So when we had a partnership or an S corp return, of course, we had Schedule K, and then you had Schedule K1, which distributed out the amounts from Schedule K to the individual partners or shareholders. With a trust, it's still called a Schedule K1, but what it's distributing out is the amount that is due to that beneficiary just from the 1041 itself. So you remember on the 1041, line 1 was interest income. So that is line 1 on the K1 is that beneficiary's share of the income. So they just use the K1 because it's a familiar form schedule and it works similarly to the partnership and the S corp since it is distributing out the entity's income to the beneficiaries. But again, there's no actual Schedule K. But this is what that K1 would look like. As we said, the trust itself is oftentimes going to pay income tax instead of the individual beneficiaries. So these are the tax brackets for a trust or an estate. The first $2,900 is taxed at 10%. And then you can see you've got a 24% bracket, a 35% bracket, and a 37% bracket. So you will want to remember those brackets 10, 24, 35, and 37 for the exam. And then you just might want to remember that it's any amount over this 14,450 that is in the highest bracket. But it is, again, brackets. Just like with individuals, the first $2,900 is always going to be taxed at 10%, the next amount at 24%, et cetera, until we get to the maximum amount of 37%. So any amount over the 14,450 will be taxed at 37%. That is what you need to know about retirement plans and estates and trusts for the EA exam. And it is also the end of video 9 and the end of part 2. Congratulations on making it this far, and I will see you in part 3.